Hello. In this video, we'll work through our trading stocks class examples. So we'll look at basic long transactions, buying stocks. We'll look at short transactions, where we can bet on a stock price going down. And we'll look at margin transactions, where we can use leverage or borrowed money to purchase stock. Also, all of our short transactions will be margin transactions as well. So we'll see that when we get into the short transactions. So we're going to talk about these different transaction types, and we'll calculate returns for each one of them. So before we get into the actual transactions, I want to just take a couple of minutes and talk about returns. So we know returns are the rewards for investing, right? Why do people invest? To make money or to earn returns. And we know that our returns can come in two different forms. Okay, the first form is income. If we buy a stock, the stock may pay dividends. Okay, if we buy bonds, we'll probably get interest. Okay, those are income components of the return. The other form returns come in is capital gains. And when we talk about capital gains, we're just talking about the increase in value of the asset. Or it could be a capital loss if the asset decreases in value. So we buy a stock for $10, it goes to $15, we've got a $5 per share capital gain. Finally, when we talk about returns, we can talk about dollar returns or percent returns. A dollar return is just what you earned in dollars, while a percent return is going to be what you earned as a percentage of what you invested. Okay, so anytime we're talking about percent returns, it's always going to be, okay, we're talking about percent returns, they're always going to be what you earned divided by what you invested. Okay, and that's going to be the case anytime we're talking about percent returns. Now, we'll have slightly different equations for calculating returns depending on the type of investment and whether it's long or short or whether we use margin, but it's always going to be what you earn as a percentage of what you invest. Okay, so that's kind of our basic formula. All the other formulas we're going to use are just going to be variations of this. For example, we could say that our percent return is just our dollar return, which would be what we earned in dollars, divided by what we invested. So anyway, let's just keep that in mind. And when we talk about returns, we're generally going to talk about percent returns rather than dollar returns. And that's because that's how we generally think about returns. We think about them as percentages. And one of the reasons is because if you're doing it as a percentage, the scale doesn't matter. Okay, so if we're talking about the returns to a stock or to a mutual fund, it doesn't matter how many shares we've invested. If the fund returned 18%, it doesn't matter if we invested $100 or $1,000. Okay, so by looking at percent returns, we kind of take scale out of the picture. And so it's actually a little bit more useful. For example, if we had an investment that had a dollar return of $1,000, is that good? Well, it depends, right? If we invested $1 million, a dollar return of $1,000 isn't real good. But if we invested $500, a dollar return of $1,000 would be great. Okay? But if we just focus on the percent return, how much we invested doesn't matter. Okay, if you take the $1,000 divided by the $1 million investment, right, what we earned divided by what we invested, you get a percent return of 0.1%. Okay, so we know it's not a very good return. But if you look at the second investment where you invested the $500 and got the $1,000 return, well, what you earned, 1,000 divided by the 500 you invested, is going to be a 200% return. And so if we focus on the percent returns, it's going to give us more information and make it easier to talk about. So let's go ahead and look at our class examples. And so we'll start with the first one. The first one's pretty basic. be similar to what you've done in 3105 in terms of just calculating a basic return. So it says you believe Argonne Corporation will rise over the next year, so you decide to take a blank position in Argonne stock. Well, if we think it's going to go up, we want to buy the stock, so that's going to be a long position. Okay, when we're buying a stock, or if we're buying any asset, we're taking a long position in that asset. So when you hear long, think ownership, you're buying. Okay, we buy 100 shares at $40 a share, and a year later we sell our shares for $48 per share. What is your capital gain? Okay, well again, the capital gain we just talked about, that's the increase in the value of our investment. Now we could do this two ways. We could multiply everything out, or we could do it on a per share basis. I generally do things on a per share basis, but when we start dealing with margin and short sales, we're actually going to have to multiply things out. So sometimes we'll need to multiply them out. Sometimes we can do it on a per share basis. So I'll just do it both ways here. Okay, so if we buy 100 shares at $40 a share, 100 times 40, we invested $4,000. Okay, now a year later, so wait, here we were buying, a year later we're going to sell our 100 shares at $48 a share. 100 times 48 is 4,800. Okay, so we bought at 4,000, we sold at 4,800. You take the difference, we have an $800 capital gain. That was our increase in value. Okay, and that's also going to be our dollar return on this investment. Right, our dollar return would normally be composed of two components, an income component and a capital gain. Well, this stock didn't pay any dividends, so we don't have an income component. So all we have is the capital gain, and that's going to be our dollar return. All right, now if we did it on a per share basis, it's actually probably a little bit easier. We would say, hey, we buy at 48 and we sell at 40. We make $8 per share. So then we take our $8 times the 100 shares we bought, and we get $800. Okay, so we get the same thing either way. And like I said, generally if I'm calculating returns, I'm going to do it on a kind of a per share basis and then multiply by the number of shares. But there's some things that we'll actually have to multiply everything out for. Okay? Okay. So the next question then is, what is our holding period return? And again, anytime we're calculating returns, and it's a percent return, right? Anytime we're calculating returns, it's going to be what you earned over what you invested. Okay, since we already have the dollar return, this could be pretty easy. Holding period return is equal to the dollar return divided by, and it's a holding period percent return, is equal to the dollar return divided by our investment. So in this case, we had a dollar return of 800 divided by our investment of 4,000. And that's going to equal 0.20 or 20%. Okay, again, it's just what did we earn divided by what we invested. Well, we had a dollar return of 800 on a $4,000 investment. That's a 20% return. Or if we do it on a per share basis, generally if I'm calculating a percent return for stock, I'm just going to do it on a per share basis. So the ending price minus the beginning price, that's our capital gain, plus any dividends, that would be the income component. So this first part's capital gains the dividends would be income. Okay, and then I'm just going to divide that by what we invested, the beginning price. Okay, and if it was a bond, we could take the ending price minus the beginning price plus interest divided by the beginning price. Okay, and since we're doing a percent return, it doesn't matter if we bought 100 shares or 1,000 shares. So in this case, we would take 48 minus 40 plus 0, because there were no dividends in this, divided by 40, and that's going to give you 8 divided by 40, which equals 20%. So again, most of the time I calculate returns on a per share basis, but if I've already got the dollar return, it's easy just to divide by however much you invested. Okay. So part C then says, if we had not sold, what would our return have been? If we hadn't sold, what would our return have been? Okay, so this is actually kind of a trick question. It actually doesn't matter whether we sold the stock or not. Our return is the same. Okay, so our return would still be 20%. It would just be an unrealized return. Okay, so here in the original example, we bought at 40 and we sold at 48. When we sold, we realized our return. Okay, and when we realized our return, we had a tax liability on that, assuming it's in a taxable account. Okay, as long as we never sell, we don't have a tax liability. Okay, we don't have to pay taxes on gains until we realize them. So in this case, if we haven't sold, we've still got a 20% return. It's just unrealized, where in the initial example where we sold, it was a realized gain. But in either case, our return is still 20%. We're still, our investment is still worth 20% more than it was. Okay, so let's go on to the second one. And this one says, you buy 20 shares of Electric Amalgamated for $650 per share. 1 year later, it's trading at $6.65. During the year, it paid $10 per share in dividends. So what was your dollar return? Okay, well, if I'm calculating my dollar return, I actually have to multiply things out. Now, actually, I could take the difference in the share price first and then multiply by 20. But anyway, I'll do it both ways. All right, so we're going to buy 20 shares of stock at $6.50, and that's going to be a $13,000 investment. And then 1 year later, it's trading at $6.65. So 20 at $6.65. Multiply those together, you get 13,300. So I'm going to have a capital gain of $300. Okay. In addition, during the year, it paid $10 per share in dividends. Okay, so I've got a capital gain component here, but I'm also going to have an income component, which is going to be $10 per share times 20 shares, which is going to be $200. Okay, so my total dollar return is going to be the $300 capital gain plus the $200 in dividends or income, and so my dollar return is going to equal $500. Okay. Alternatively, I could have said, hey, I've got a $15 per share capital gain, right? bought at $6.50. It's now at $6.65. It's gone up $15. So a $15 per share capital gain times $20 a share would give me 300, and then again the $10 dividend times 20 shares would give me the 200, and I'm right back at 500. Okay, so either way is fine. And once we have the dollar return, if we want to calculate the percent return, which is the next piece it asks for, I can just take the dollar return divided by our investment. So we made $500 divided by a $13,000 investment. That doesn't sound great. That's going to be 3.85%. Okay, or 0.0385 is what your calculator is going to say, right? But if it's 0.0385, that is 3.85%. Now, if I hadn't already multiplied all this stuff out to get the dollar return, I wouldn't have done that. I would have again gone back and looked at this ending price minus beginning price plus dividends divided by beginning price. I would just calculate my return on a per share basis, which would be $6.65 minus the $6.50 we paid for it. That's going to give us a $15 plus the $10 capital gain, $10 dividend divided by the $6.50, and that's going to give me 25 over $6.50, which should equal, I was off the screen on all of that. I'm sorry. Yeah, so what we're saying, right, if we're doing just the percent return and we already have the dollar return calculated, we just take the $500 return divided by our $13,000 investment. Or if we're doing it on a per share basis, $6.65 minus $6.50 gives us a $15 capital gain plus the $10 in dividends gets us 25 divided by $6.50, which is going to be the 3.85%. Okay, so those, you should have done ones like that in 3105, so hopefully that's just kind of refreshing your memory a little bit. So let's go on and look at the next one. All right, so the next one says, we believe Death Star Industries stock will fall. How can we profit from this? Okay, well, if we think a stock's going down, we're not going to buy it. Okay, so what we would do is we would short it. Okay, so we would short Death Star Industries. Okay, and so let's talk about short sales for just a second, kind of refresh your memory on that. So we can bet on a stock going down by shorting it. So how do we do a short sale? How does it work? Essentially, what you're doing is you're going to borrow shares of stock from someone else, and that's actually going to be essentially from your broker. Okay, you're going to borrow shares of stock and you're going to sell them. Okay, so we're going to have money coming into our account. We borrowed 100 shares, we sold them, we got money coming into our account. But if we borrow the shares, at some point we have to return them. Okay, which means at some point we're going to have to buy the shares back, or the terminology we'll use is cover our short position. So we're going to have to cover our short position by buying back the shares so we can return them to whoever we borrowed them from. Okay, so what we're hoping is that the price goes down. Okay, so let's say the stock's trading at $100 a share and we think it's going to go down, so we short it. So we borrow some stock from somebody else, we sell it, we've got money coming in. Now the stock's dropped a bunch. At least that's what we're hoping is happening. It's going to drop a bunch. It's going to fall to 50. Now we're going to buy back 100 shares at the lower price, okay, to cover our position. So we're still trying to buy low and sell high, which is what you try to do when you take a long position, right? You're buying a stock thinking the price is low and it's going to go up and you can sell it higher. So here we still want to buy low and sell high. We're just doing it in reverse order. We're going to sell high, and then when the stock falls, we're going to buy it back at a lower price. Okay, so that's basically how a short sale works. Okay, so in this example, to make money from this, we're going to short 1,000 shares of Death Star Industries at 980, well, I guess we're in pounds now, 980 pounds per share. Okay, so what we do right now is we sell 1,000 shares at 980 pounds. And what that's going to do, that's going to give us 980,000 pounds. Okay, so that's going into our account right now. We borrowed some stock and we sold it. Okay, now at some point we have to return it. We have to return the shares we bought. So now what happens here in this case is the price falls. This is what we were hoping. All right, so now we're going to buy 1,000 shares at 240. Okay, and so that's going to cost us 240,000 pounds. Okay, and what do we do with these shares when we buy them? We return them to the person we borrowed them from, and we've closed out our position. So when we buy a stock, we close out our position by selling the stock. When we short a stock, we close out our position by covering or buying back the shares at a lower price. Well, hopefully it's a lower price. If the price goes up, we've got other issues. Okay, so so how much money did we make here? Well, we bought at 240, we sold at 980. If you take the difference, we made 740,000 pounds. Okay, so this was great. We thought Death Star was going to go down, so we shorted it. We sold it at 980. We bought it back at 240, and we made $740,000. Okay, but what if the stock goes the other way? Okay, so we shorted 1,000 shares at 980, and then Death Star stock starts rising and it's up to 1,200 per share. How much money do we make or lose here? Okay, well again, what we do, we borrowed shares of stock, and again, we sold the 1,000 shares at 980. We got 980,000 pounds in our account. And now, if we cover, we would have to buy 1,000 shares at 1,200, and that's going to be 1.2 million. Okay, so in this case, now we take the difference. We bought at 1,200, we sold at 980. Again, it's just reverse order. But what we did there is we lost 220,000 pounds. Okay, so the stock went the wrong way. We thought it was going to go down. We sold it, we shorted it, so we borrowed shares of stock from someone else and sold them, got 980,000. Price went up, we had to cover our position. We bought the shares back at 1,200, So we paid $1.2 million for them and gave the shares back to who we borrowed them from. So we lost $220,000. Okay, so that one was a loss. All right, so part C then says, assume Death Star stock rose to $1,200 and that Death Star also paid dividends of $8 per share. How much did you make or lose? Okay, well, we already know we have a capital loss of 220,000 pounds. Okay, that's what we calculated right here. But now this one has added dividends into the equation. Now here's something kind of unique about short sales, is with short sales you never get dividends, right? We buy a stock, we may get paid dividends. If we short a stock, we're not going to get dividends. Not only that, we're going to have to pay dividends, okay? Because we borrowed the stock from somebody else and sold it to another person. Well, the other person's going to get dividends because they own the stock. The person we borrowed it from, they don't realize they don't have the stock. It's all taking place behind the scenes. So we actually have to pay them the dividends they would have received on the stock they borrowed. Okay, so in this case, if they paid an $8 per share dividend, we're going to have to pay should be pounds. Okay, we're going to have to pay 8 pounds times 1,000 shares. So we're going to have to pay another 8,000, and we're going to lose 228,000 on this transaction. Okay, so again, just kind of to clarify what's going on, the borrowing of shares and so forth, that's taking place behind the scenes. Generally, when you buy stock, if you set up like an online brokerage account and you buy stock, you're not going to actually receive the shares of stock. Okay, the shares are going to be issued in the street name, which means in the name of the broker. Okay, now if you want the shares in your name, you can have them actually send you the shares in your name and you can store them in your safe deposit box. Okay, generally people don't do that. Okay, when they buy the stock, the shares are issued in the street name, so in their broker's name, and the broker just credits their account for those shares. So the broker has all these shares of stock, and so if somebody wants to short a stock, the broker just does it. Okay, and the broker is responsible for making sure that whoever they borrowed it from gets paid back, because they've got the shares in their account. So, but again, all of that's kind of behind the scenes. If you in the simulator, when you short stock, okay, all you do is just like you're buying stock, you hit the buy button. Well, now you hit the short button, and when you want to cover, you hit the cover button. But behind the scenes, what's actually going on is you're borrowing shares of stock, and since you've borrowed those shares of stock and then sold them to somebody else, any dividends that get paid, they're going to go to whoever you sold the stock to. So you're going to have to pay the person whose shares you borrowed, you're going to have to pay their dividends. And again, the broker will take care of that. They'll take that out of your account. So anyway, and this is actually a simplified example here, right? We didn't calculate the returns on this, right? What was our return here when we made 740,000 pounds? Or what was our return when we lost 228,000 pounds? Okay, we haven't calculated percent returns, and the reason is because short sales are margin transactions. Since we're borrowing the shares, we're going to have to put up collateral, and it's going to change the way we calculate returns. So we're not going to do any return calculations on this one. I just wanted to kind of give us a a basic short sale, just to kind of get the idea across of what's going on when you short a stock. So when we do our next short example, we'll actually calculate the returns, and we'll have to figure out how much margin we have to put up and things like that. But this is just the basic idea of short sales. You're borrowing the shares from someone else, you're selling them, and then you're hoping the shares go down and you'll buy them back at a lower price and then return them. Okay? And again, if a shorted stock pays a dividend, you're going to have to pay the dividend for the person who you borrowed it from. All right. I think I'll just go ahead and stop this video here, and we'll do the next ones in a separate video.